At Scion Capital, my job 24/7 was to ask questions and seek answers. I mostly examined stocks and bonds as long investments. But one day I came across a subprime residential mortgage-backed securitization. And I wondered if I could figure out any of that. Other questions soon followed. Why are home prices diverging up and away from the household income trend line? Answer, if it's not income, it's leverage. What exactly are the incentives of lenders that make mortgages only to sell them on through to Wall Street? Answer, volume at the expense of credit standards. When interest rates bottom, how far could lenders push mortgage terms in order to keep refinancings, home prices, and loan volumes rising? The answer to this question would put a ticking timer on the boom and a date on the crash. Back in 2005, other questions stood out. How much is consumer spending dependent on cash-out refinancings? What percentage of jobs are dependent on the assumption of rising home prices? Won't AIG have to start posting massive cash collateral for the first time if it were downgraded? Isn't it worrisome that Fannie Mae cannot find term sheets that describe perfect hedges against its massive mortgage portfolio? Are the rating agencies so conflicted that they could be this blind? In my letters to investors, I described a downturn that would be unprecedented, with no counterpart in the modern era. Wall Street's risk models would fall all at once, and every single CEO and every single politician would be disastrously wrong. I put my money where my mouth was. At its peak, I was short $8.4 billion worth of subprime mortgages and certain financial companies. The most we could lose was less than $100 million, thanks to credit derivatives. And at first, we did lose. It was a negative carry trade. Investors, business partners, and even employees questioned the strategy. Lawsuits were threatened, our distress was reported in the press, and Wall Street looked to squeeze our short. Besides all this, I had to stomach what I knew was coming: a tragic end to the follies. This was not fun. I did not tap dance to work. But the firm survived. We turned the tables on Wall Street, and I became the 1% in a way I never imagined when I was sitting where you sit today. I had bet against America and won. In 2010, I published an op-ed in the New York Times posing what I thought was a valid question of the Federal Reserve, Congress, and the President. I saw the crisis coming. Why did not the Fed? Never did any member of Congress, any member of government for that matter, reach out to me for an open collegial discussion on what went wrong or what could be done. Rather, within 2 weeks, all 6 of my defunct funds were audited. The Congressional Financial Crisis Inquiry Commission demanded all my emails and lists of people with whom I had conversed going back to 2003. And a little later, the FBI showed up. $1 million in legal and accounting costs and thousands of hours of time wasted, all because I asked questions. It seemed they would pump me at gunpoint or not at all. That summer, the Federal Reserve put out a paper that concluded nothing in the field of economics or finance could have predicted what happened with regards to the housing bust and subsequent economic fallout. Ben Bernanke continues to backfill this logic, and I fear that history is being written wrong yet again. The ignorance is willful. As we move forward as a country, It is worth considering mainstream economics and finance in light of recent events. Our nation's economic policies are born of a synthesis of theories on how to deal with the Great Depression of the 1930s, yet seems unable to honestly examine the most recent one. Sadly, at the highest levels of economic thought in government, questions are not tolerated. It is as if we are dealing with the binary judgment of a fundamentalist religion. Finance theory and practice fare no better. The continuing crisis makes a mockery of the principles which have guided credit policy and risk management since the 1960s. As it turns out, information is not perfect, volatility does not define risk, markets are not efficient, the individual is adaptable. But the dark ages of finance allow no such light. Mainstream economists and finance practitioners, please check your premises. You have contradictions before you. Truthfully, I do not expect much to change. Practically speaking, history has demonstrated the ability of sovereign nations to justify themselves and to postpone the moment of crisis. This will be even more true for the United States as the largest economy by far with the strongest central bank. As a result, over the course of your lives, you will experience withering but stealthy attacks on your quality of life as government attempts to manage its faltering finances. You will see declines in the quality of health care, the quality of education, the quality of public safety, and the quality of our currency. Of course, this is a false prophecy. I am simply describing what is already happening.